Welcome, everyone. Welcome to this risk readiness webinar. I'm Ann Adams, Senior Product Manager for Business Solutions at RMA. Today's webinar is going to be the latest installment of Credit Trends in Commercial Lending. It's presented by Tom Cronin from AFS. Thank you, Tom, as always. During the presentation, if you have a question for the speaker, just please submit using the Q&A feature at the bottom of your Zoom screen. We'll address as many questions as we can at the end of the presentation. So thank you again. And at this time, I'll turn it over to Tom from AFS, and thank you for joining.
So thanks, Ann, and welcome to everyone on a sunny but cold spring day in northeastern part of the country here. So today we're going to do something a little bit different. So this is the fourth year since the beginning of COVID, just about the time everybody or a lot of people went home. And so therefore, every trend chart you see today, I'm going to start with March of 2020 and then end with March of 2024. I was really curious to see how things might have changed over this 4-year period. And as we go through these charts, you'll be able to see, the jolt from COVID. There was a recovery period afterwards, and then lately, the impact of inflation and the high interest rates. All right, so let's get going. So as usual, our data source is the Credit Risk Navigator. And after February's webcast on the survey that everybody fills out, or we ask you to fill out, I was asked to show how a bank might use the Credit Risk Navigator to research a particular market segment. And so I wanted to show you how somebody might do that. And I'm going to go over to the actual webcast, if I can, actual chart. Here we go. So this is the Credit Risk Navigator, and I'm on the early warning problem loan management report. And you can see across the top are the tiles, the past due and non-accrual bookends, as I call them, the performance bookends, and then classified and criticized loans in the middle, which are based on the RMA 10-point scale. The speedometer is giving you high, low, and average based on historical results, and then the 4 charts that show here we're showing classified loans for the bank on the top left, classified trend on the top right, and then the worst performing industries and the worst performing CBSAs on the bottom. And I'm not going to show you exactly what one of our banks did, but I'm going to use sort of a proxy here. We had a bank that was interested in a particular market, and what they wanted to see was what was the classified loan volume in that particular market, that particular segment. And so what they did, and again, I'm sort of disguising it, we had these filters. So they clicked on this filter and they opened up industry. And for this exercise, we'll just say they wanted to increase their dealer floor plan with new cars. And so they would come in and simply click on, if I can get it, sorry. Oh, let me try again. Oh, we'll try. Here we go. So they'll click on dealer floor plan, and you notice 6.4 was classified loans. So their experience with classified loans was at 3.2 for dealer floor plan. And then the market itself, if we'll open up the chart, you can see the market is at 1.42% for classified loans. So this is very similar to what this other bank did. They saw similar results. So this told them that going into this type of market was something that would be of interest to them because of the credit quality involved there. So that's one of the ways banks can use CRN to research new markets. So let me go back to the PowerPoint now, and I'll open it back up. And I'll move on. So that example is in here, but we'll move on. So we're going to start with C&I. And again, a quick definition for those of you who are new. C&I is loans for business purposes to companies with annual sales usually north of $1 million. And these facilities are manually underwritten and risk graded And loans secured by owner occupied real estate is in here. Investor owned real estate will come later on. And I thought it'd be worthwhile to add the next three charts that you're going to see, just to kind of remind everybody of what's been happening the last 4 years. You know, what's been the drivers, so to speak, of the economy. This is the COVID death charts, and you can see the spike early on in the 20s, and then again in the winter of 2020. Then things got better in the summer, got worse again in the winter, but since then have kind of leveled off to where, you know, in my newspaper, you don't hear much discussion about this anymore. The next one is the inflation trend. It sort of followed along with COVID, but after, you know, the first, second, or third wave of COVID, the inflation trend had really jumped up to the 9% range. Then we'd come back down, but then sort of leveled off. But then you notice I made an adjustment today for the rate that came out at 1.6%. So that's where that star is. So obviously a much, at least from the Fed standpoint, I guess they're feeling a little bit better about this. And then the last chart is the Fed funds. So just a depiction of interest. And this is the Fed funds chart. And you can see it went up starting in the early 2022 and has remained high. And up until today, you know, the prospect for higher for longer was very real. It'll be interesting to see what happens now that it looks like inflation might be under control. Okay, so that's the backdrop. And let's move on to the first chart. And again, this is, if you've been with us before, you usually see that I start in 2003 and come forward, but I'm just concentrating on the last 4 years here. And again, this is the non-performing is the red. And when I say non-performing, I'm talking about 90 days past due plus all loans that are on non-accrual. And let's start with that. So non-performing loans jumped within a few months and peaked at 1.2% in the fall of 2020, starting on the left and moving to right. Then we saw a slow and steady return to pre-COVID levels. It actually got better than where we were prior to COVID for the next 2.5 years. But as you can see, since around April of 2023, the non-performing level is creeping up with a little more speed lately. And we'll look at a number of sectors on the next few slides and talk about what's been impacted. But clearly the high levels of inflation and interest rates are beginning to take a toll. As to sorry, I went too fast. As to delinquencies, 60 to 89 days had a spike early in 2020, but have basically been around 0.10% for some time now. And the trend in short-term delinquencies has been very erratic and frankly, very puzzling. And if you've joined us before, you've heard me talk about this. Well, we're now well below where we were in early 2020. The volatility throughout this 4-year period has been unprecedented in Credit Risk Navigator history. And I'm not sure we're going to see delinquency stay in the 0.2% range for any period of time. Pardon me. Just a year ago, we were below 0.2 and then shot up to almost 0.08. So before we move on to the non-performing, I wanted to see if Ann could launch our first poll as we discuss here a little bit this 30 to 59 days past due.
Yep, 1 second.
Okay, so what we're interested in, one of the things in talking with our customers we've heard is that not all of the 30 to 59 days past dues customers or loans are due to credit reasons. So what we're trying to find out is what percent of your 30 to 59 days past due are due to administrative issues, not credit. And an example of an administrative issue could be you're trying to get renewal documents done. You're renewing a line, trying to get the documents done, and they're being held up by lawyers or an appraisal. Could be that the person is arguing about the payment. Could be that the company itself is just holding back money for cash flow purposes. So this would be anything that's not related to pure credit issues.
I'm gonna give it a couple more seconds because it's interesting how in this scenario, at least, some of the earlier answers had a different skew than some of the later answers. So let's give it a couple more seconds here. Okay, it looks like responses are slowing down. Thank you.
Okay. So 47, 31, 16, and 7. Okay. So most of you are saying 25% or less. So about a quarter. Okay. All right. In the webcast coming up, maybe another month or so, we'll come back to this. We've got an idea of how to treat some of these. All right. So let's move on. Apologize. To non-performing. And a quick explanation of what I've done here. So for each of the 2-digit NAICS codes, I'm showing the non-performing result for March of 2020, March of 2022, and March of 2024. And when I first put that onto a chart with all 24 NAICS codes, it was really hard to read. So we split it out. So you have half of them here and half on the next page. I just think it's a little bit easier to digest. And there's a lot here, obviously, 3 times 24, so 72 data points. But I thought if you would just look at a couple things here with me, and then you can look at the rest on your own. First of all, if you would look at the 3 manufacturing sectors, so 31, 32, and 33. Particularly 31 and 32, you can see that they're significantly higher 2024 versus 2020. 31 and 32 are actually more than double. We're going to take a look at those a little bit more. But those were the 2 that sort of stuck out to me right away. Again, also retail on the tail end there. On the next chart, there are actually 6 sectors here that are north of 1%, same as what we saw on the other chart. The best chart here, the best one is 52 finance. Pardon me, you can see just very little non-performing loans there. Same with management, 55. And I'd also mention that 52 finance is also one of the largest sectors that we have. So that's a lot of loans doing very well. So I wanted to take a little deeper look at what's happening with manufacturing and 2 subsectors specifically. And what we have here, this is the historical trend for 312 beverage and tobacco manufacturing. And let me explain the color scheme here first. So the green is the best. So we went back over the 21 years worth of CRN, looked at the historical averages, the historical performance. The best quartile is in the green, the worst quartile is in the red, and the average is the 2 middle quartiles. And so what you see here with 312, and this is one of the few charts where I'm looking all the way back to 03. You can see the hit it took during the recession, where it went up in a little bit north of 2%, then recovered, and actually was doing historically well 2 years into the COVID period. And then the increase came in late 2022 due to inflation and higher costs. And almost all of this is is related to beer manufacturers, and almost all specifically to craft breweries that have been hit not only with cost, but also a reduction in sales as the preference for alcoholic beverages has shifted away from beer in general to more spirits and what I've been told is ready to buy cans of alcohol. So this combination of a change in appetite as well as inflation is causing problems for the beer industry. The other manufacturing segment, so here's the same chart. This is 326 Plastics. And the results are very similar. Again, hard hit by the recession. And at the outset of COVID, it got hit again early 2020, so a little bit different. But once again, you're seeing historical highs. And why is it high? It's a combination of inflation's impact on these borrowers' cost structure, as these are intensive capital expenditure intensive industries, so they borrow a lot. The high interest rates are impacting that interest expense for highly leveraged firms. And on top of that, you have the environmental pressure of reducing the use of plastic bottles and other containers. So again, a picture of two industries that are at their historical worst, and having some issues going forward. All right. So now we'll move on to credit quality. And I'll take a second to explain what I've done here. When a bank joins Credit Risk Navigator, we map their borrower risk ratings to the RMA 10-point scale. And on that scale, borrowers rated 1 through 6 are pass. Borrowers 7 through 10 are what you would call regulatory-wise criticized, following the normal regulatory designation, with 7 being special mention, and then 8 substandard, 9 doubtful, and 10 loss, which we've depicted here as classified. And as we've been working with the CRN banks on some risk migration studies, we found that a large percentage of borrowers risk rated 6 deteriorate and end up falling into the criticized category. So with this chart, we've added the 6s to the criticized, and we call this combined segment distressed, with the idea being that in terms of economic uncertainty, some of these 6s, which you see in the blue, are going to migrate up into the yellow or the red. And so it's better to look at this as a holistic group. So the overall direction here matches what we saw with the non-performing trend. You see the increase due to COVID, and then the recovery by late 2022. And then inflation and the high interest rates impacted this number in the summer. And we've been climbing up now for about, I think it's 7 or 8 months in a row, where the distress level has increased. So let's take a look at what's being distressed. And again, I'm splitting this into the NAICS into 2 separate charts. It's just easier to see. And just about every sector has a higher level of distress now versus what they saw in 2022. There are 2 sectors that are better now than in 2020, and those are on the next page. 71 arts, entertainment, and 72 accommodation and food. For the arts, there was an improvement in the amusement industries. For 72, both hotels and restaurants improved, but I would make a note that even though they've improved, the amusement industry and restaurants are still very high. Both are close to 40%. Okay. So I'll let you look at some of these others, but as you can see, just about every one is above, again, with what we just mentioned, exception of what we just mentioned, everyone's above where they were in 2020. And if you say that risk ratings are the outlook, then the outlook would not be all that great. So before we move on to CRE, I wanted to wrap up with a side-by-side look at the performance and credit quality using weighted average risk rating, or the blue line, for credit quality. And throughout most of these 4 years, these 2 measures tracked pretty closely. But lately, the credit quality measure is increasing or displaying poor credit quality at a faster rate than the decline in performance. So the supposition or the assumption we have here is based on what we have seen in the past. With this blue line or the weighted average risk rating increasing, we're pretty much expecting performance is going to follow that. And you can see it's starting to tip up there at the end. So we would not be surprised if this number continues to go up to the right-hand side. All right. So we're going to start now, or go over now to CRE, a quick definition before we get to a couple of polls. So we follow the interagency guidance when designating a borrower as CRE. And by that, I basically mean if more than 50% of the loan repayment comes from the sale or rental of the property, that's CRE. And these are the portfolios that are often referred to as investor owned. All right. So now we have a couple polls here, all related to CRE. So Anne, if you could launch that second poll.
Yep.
So one of the things we're interested in is which of the following metrics are important or are most important when you're underwriting a commercial real estate loan? Is it loan to value, debt service coverage ratio, the cap rate, net operating income, debt yield, or occupancy percent? So whichever one that you tend to focus on the most, we'd be curious as to how you answer that question.
Great, thank you. Looks like most of the answers are coming through.
Okay. Right, so loan to value is 13, debt service 70%. 277 Okay. All right, thank you for that. I was thinking that it might have been more of a split between LTV and debt service, so I'm glad we asked. So Anne, could you launch the second question, please? Or the third poll question? So there's been a lot of publication or a lot in the press about loan modifications. I saw one the other day, one of the large REITs just got a modification where they basically wiped out half their loan and brought it back current. So our question is, when you're offering, or how often are you offering loan modifications for stressed CRE borrowers? These are kind of random numbers. So frequently would be greater than 10%. Occasionally would be 5 to 10% of the borrowers, and infrequently would be less than 5%. And again, this is a ballpark number that we're looking for.
So great, thank you. Looks like most of the responses are coming through.
Okay. So 10, 35, 55. Okay. Thank you for that. I think we had asked this about 6 months ago, and the numbers were pretty close to what we're seeing. So there's not a lot of modifications. So the next poll, the last poll, this is the last bit of work you have to do. So when you are offering loan modifications, what are you offering? And again, you can choose more than one answer here. Are you extending the term? So going, moving the maturity date out a year or more. You're doing some bridge loans to help them get through a particular tough payment or part. Delaying payment, cutting the interest rate, restructuring the loans, or not offering modifications at any time, at this time. So we'll wait to see what you have to say here.
Okay, thank you. Looks like most of the responses are coming through.
Okay. Term extension, the big one. 20. Interest rate restructuring 33. Okay. All right. Thank you very much. All right. So let's go on to CRE. So here's again the non-performing and delinquencies. Non-performing in the red, short-term delinquencies in the green, and the medium-term delinquencies in the blue. So we'll start with delinquencies first this time around. And after that first short-term past due spike in early 2020, so I think that was actually March, the 30 to 59 day level has stayed relatively close and in the 0.5% range. You're seeing some variation, not as much as what we're seeing with C&I, just sort of floating around in the 0.5% range. And the medium term past dues have been even lower than that, a little kick up recently, but basically relatively level. The non-performings, however, have been a bit more variable. Prior to COVID, the non-performing percent for CRE was 0.32%. By late 2020, it had reached 1.36%, so up 100 more basis points. We saw some improvements in late 21 and early 22 down into the 0.8% range. But since then, the level has been steadily increasing and is now at 1.09%, even with a recovery here, or a little bit improvement in the last month. So let's take a look at what's happening at the property type level. And I think you're going to be surprised because obviously all the publicity has been about the problems with offices. But if you get anything out of this today, I want you to take a look at this next chart and understand that what we're seeing is saying it's more than just offices. So here's non-performing for the top 8 property types, with top being based upon loan outstanding. So these are the 8 largest property types. Let's begin with lodging. They're on the left side. It started March of 2020 as one of the best performing property types, along with industrial and actually office. But by 2022, the middle of this time period, it became the worst performer, just shy of 6%. But then as primarily business travel picked up, personal travel picked up first and then business travel, the performance improved. And now it's still not great. It's a little, about 2.5, but it's not the 6% that it once was. So let's move over to office. It also was one of the best performers starting at this time period and was still in good shape by 2022. But then as leases expired, tenants reduced square footage or dropped office space altogether, office vacancy has soared. I think the last number I saw was just below 20%. And now offices are just shy of being 4% non-performing. And before we leave this, I wanted to mention one more type, and that's healthcare. So in 2020, when COVID first hit, healthcare was the worst performing property type. And while it's been eclipsed since then by other property types, its non-performing level has steadily increased during this period. And there's been a lot of press lately with the Wall Street Journal about some of the major healthcare providers having problems. And that's lending, I think you're seeing that play out here. So again, what I wanted to make sure you knew or saw was that yes, offices are the worst performers, They're not the only one, though, I think, to be concerned about. So a little bit more on healthcare. I thought we'd examine this for the location of the property. That's one of the things we can do with CRN. And you can see that there are elevated levels for healthcare in the Northeast and the South. And within those two regions, in the Northeast, they're seeing problems in New York, specifically New York City, and then also Connecticut, Bridgeport, and the Hartford area. And then in the South, we're seeing problems in Florida, in the Orlando area. All right. So once again, we're going to look at distress, so credit quality and distressed. And just a reminder, this is low pass and criticized. And the trend mimics what we saw with C&I, with one exception, one important exception. Pardon me. While the directions are the same, an initial hit from COVID, a recovery period, and lately a deterioration in credit quality, what we're seeing with CRE is that the most recent increase in distress levels have taken the percent distressed above what we saw with the initial stages of COVID. So we're worse off now than we were at the height of COVID. The distress level for March of 2024 is approaching 40%. At the height of COVID, it was 38.0%. So let's take a look at the property types and see what's happening here. And with the exception of lodging, every property type now has a higher level of distressed loans than what we saw as of March of 2020. Office is obviously the worst. I think everybody on this call has to know that. But lodging is higher than it used to be, but it's recovering and coming back down. The two that give me a lot of concern are the two on the far left. So healthcare, which we just talked about from a performance standpoint, you can see its percent distress is now approaching 50%, as is industrial. And industrial has been thought of as sort of the darling property type, but as the slowdown in e-commerce sales has occurred, we're finding, or what we're hearing from our customers, is there's a lot of industrial space that was built on spec and is now sitting vacant. So there's concern about that. And then multifamily, you see, is also a few points shy of 40%. Again, there's been a lot in the press about multifamily, not so much with New York Community Bank. Obviously, they had a ton of multifamily. That was sort of different, but a lot of units coming online that the thought is that's going to drive down your rent and the company's ability to increase rent. And with not being able to increase their income, their rent or their income, and then faced with the inflation numbers, it's going to put a strain on cash flow. And that's why I think you're seeing distress levels for multifamily climbing so high. So here's our last slide. And again, this is comparing performance versus credit quality. And I'm non-performing versus the weighted average risk rating. And these levels have recently converged on the chart. If you look on the far right, or said another way, appear to be increasing at the same rate, a little bit different than what we saw with C&I. And while it's not as high as what we saw in 2020, both measures are headed that way, headed to 4-year increases. So I didn't want to do it, but I'm obviously going to end on a pessimistic note that both of these measures are seen to be heading in the wrong direction. So Ann, I'll turn it back over to you and open it up for questions.
Great, thank you. We do have a couple questions. The first one is regarding the deck. So the deck will be sent out once we get the final lists from our marketing or from our partners to be able to send that out. And then the second is the months in between quarter ends do not have the same level of emphasis and collection as due quarter and reporting periods. So I think that's just kind of pertaining to why we see kind of the up and down in the 30 days past due, that perhaps suggesting just more of an emphasis on getting things tidied up for the end of a quarter.
Yep. And that's something we've talked with some of our other banks before. I think Brad Cunningham from Commerce is on the line. He actually was the first one that mentioned that. So I'll give him credit for that. And that is pretty much holding true. But what's really strange, and obviously I don't have it here, maybe next month I'll bring it in. If you look at the past due performance from 2003 onward, it's always been volatile, but we've not seen the volatility that we've seen since COVID first hit. And as a matter of fact, I'll make a note to show you that chart for next month. You can see that, post COVID, the highs and lows are real. There's a lot of spikes that, frankly, we're still having a hard time trying to understand why. But you are right. It does appear to be that intra-quarter, if you would, the RMs aren't as anxious to collect as they are towards the end of the quarter.
Gotcha. Another question is about replay. So these recordings do get stored on rmahq.org. So you're able to be able to see the past recordings so that they are available. I can help direct you to that if you have any issues, but you can just get there by searching RMAHQ for past webcasts. And another question is, are you seeing the distressed CRE properties by geography mirror the non-performing ratios by geography for healthcare?
I'll take a look at that. I did not look at that this month. So that's something I'll do and show you next week. Or whoever's asking that question, if you want to send me an email, our emails are here. If you want to send me an email with that, I'll reply to you, but I'll make sure I'll put that in the webcast next week.
Great, thank you. A couple more to go. Have you seen, and love the feed, love the interaction. So thank you everybody for the questions. This is great. Have you seen any correlation in publicly reported bank CRE change or charge off actively relative to these NPL stats or what the banks themselves have been reporting? Are you able to see if the NPV of the non-accrual loans is so high that the loss content would be expected to be low?
I think in general we have, one of the things that we have another measure in here called loss given default that I could take a look at to see if we could answer that for you a little clearer, a more fully intelligent answer.
And 1 second, that's LTV, not NPV, and that was just a clarification that came through.
Oh, loan to value. Okay.
Yeah. So
Okay,
relative to these loan to value stats and what the bank themselves have been reporting, able to see if LTV of the non-accrual loans is so high that the loss content would be expected to be low.
Okay, that's something I would have to take a look at. Again, if you could shoot me an email, I can try to get that number for you.
Right. One more. How will the potential rate cut affect the non-performing CRE loans? What category is renewable energy under?
So I could be a smart aleck and say what rate cut, but we'll assume that there is going to be a rate cut, and any rate cut will be beneficial for CRE loans for a variety of reasons. Obviously, the interest the interest expense, if nothing else, but also it'll make CRE loans more attractive. And so you'd be able to get, if you have some of these loans that are problems, you'd be able to get out from under them a little bit easier than you can right now.
Great. At this point, that's covering the questions we have. I can give it another minute or two to see if anybody has any additional questions. And I'm not seeing anything come through. So if that is it, thank you, everybody. I really appreciate the interaction and the questions. And thank you, Tom, for sharing your insights. And thank you, everybody else, for joining. We look forward to having you at the next session on credit trends. So that will conclude our webinar. At the end, please take a moment to fill out the survey. And thank you and have a great day.
Thank you.